I am going to have people jump in later if they want to with questions. So I want to mention that. But I'm just going to start and say hello, everybody. Welcome and thank you for joining us. I am Hilary of Bright Sound Investments, a private real estate equity firm. And we invest in multifamily and senior living. And I think we're all going to learn a lot tonight from our incredible guest about investing smartly, protecting your capital, maybe most importantly. So I want to give you a little bit about Vessi Kapoulian. Vessi is the founder of Dream, Believe, Achieve Capital Group, a Los Angeles-based real estate investment firm focused on multifamily investments and assets. She was born and raised in Bulgaria behind the Iron Curtain. Vessi earned a full academic scholarship to study in the United States, leveraging education as her path to opportunity. And after initially pursuing the traditional corporate path, a series of life events prompted her to reevaluate her definition of success and ultimately pivot into real estate investing. Before becoming a full-time investor, Vessi spent years in commercial lending, where she managed and underwrote hundreds of millions of dollars in real estate loans. And that experience shaped her disciplined, risk-first approach to underwriting and capital allocation, and which is a perspective that she now brings to every investment decision. And today, she manages approximately $80 million in multifamily assets across Georgia, Tennessee, and Florida, and also invests passively in select opportunities. She is the best-selling author of Mastering Multifamily Underwriting. Hold on, I have it, guys. I have it right here.
Oh, thank you.
Amazing, amazing resource. And she's a frequent speaker on risk management, underwriting discipline, and passive investment strategy. I love this. Her mission is simple: help high achieving professionals and sophisticated investors protect the downside, build durable passive income, and create long term optionality for their families. So, wow, Vessi, you're amazing. Welcome. You have underwritten over 1,000 deals. You've managed $1 billion credit portfolio. In today's market, higher interest rates, tighter lending, what are some of the biggest mistakes you see investors making when they evaluate multifamily deals?
Well, first of all, thank you for the warm welcome, Hilary, and for the very kind and detailed introduction. It's a pleasure to be here, and I very much look forward to an insightful discussion. So, we live in a very, very interesting times, very dynamic times, right? And that's actually one of the things that I love about real estate. It's not just the real estate, but it's important to have broader awareness of both the macro picture and the global picture. And so to answer your question directly, what are some of the maybe pitfalls or or areas of opportunity, let's just call them, that I see investors make when they make investment decision? I'll tell you, it doesn't start with the numbers. That's actually the easiest part, and I can definitely talk about the numbers. But it's a people's first business. So usually where I spend a lot of my time or most of my time is building relationship with the right strategic partners and really vetting the operator. And I can dive deeper into what exactly that means. Vetting the operator, and because ultimately when you go into these investments, and specifically I focus on cash flowing apartments, so just want to give my disclaimer out there. There's obviously a lot of ways one can get involved in real estate and commercial real estate in particular. But you're getting into these deals that are 5 to 7 year marriages effectively. So it's important to understand who the people are, how they operate. It's not good or bad. It's just, do you align, right? Do they align with you? Secondarily is the market, and I can do a deeper dive into what that means and what I look for. But very often, I'd like to say that the market shapes the inputs that drive the outputs, right, for the financial models and forecasting, and therefore the pro forma returns. They really set the picture for where really the downside risk lies, and perhaps where there may be some optimism baked into into the assumptions and projections that I see very often. And the last piece is the deal. That's actually easy because it's black and white. That's the numbers, it's the structure of the deal. So going through the offering documents, specifically the PPM, the operating agreement, and really understanding not only how that works, but again, trying to answer the question, does this risk profile align with my own risk tolerance? And does this investment align with my own goals? And of course, the answer would be different for everyone because we all have different goals, objectives, and buy box and risk tolerance. So it's important to take a step back and really have clarity on those key questions. What am I looking to do and why? To stay focused and not get distracted by either shiny objects or social media fluff and maybe over marketing. So pause for a moment and happy to dive into each of these deeper if you'd like.
Yeah, that was awesome. I don't know if we want to take it from like, what do you do first and what do you
Okay.
recommend people do?
Mm-hmm.
Or we could go the other way, which is like, what are the the first red flags that you
The
look
first
for?
red
I guess
flag.
they're kind of
Okay.
intertwined.
Okay. So I'll probably I can walk you through my process, right? So I have very specific criteria. So when I get a bit an offering deck, or also known as pitch deck, I don't like the word pitch deck, but let's just use that because it's
It has a
very
lot of
common.
names actually. Offering memo,
Yes.
yeah, slide deck, yep.
So when I look at it, when I open that up, what I'm looking for is, does the deal align, right? So in that case, so if I see a property that's maybe a little bit older, aluminum wiring, something with a lot of deferred maintenance, uh, it's I guess the pink flag is sort of at the back of my mind. That's not necessarily a red flag, but I'm already thinking, okay, there better be a lot of buffers and other mitigates in this deal because I know I'm gonna be getting my hands pretty dirty, not in a bad way, but there will be a lot of work involved. Of course, location, right? I want to be in business friendly, landlord friendly states. And one of the first things I do is literally takes a couple of minutes, but I also developed a GPT that comes with the book. Actually, it's one of the book resources where people can do a very quick preliminary market research. And I want to know if the very basic KPIs of the market are there: growing population, diverse jobs, crime activity. So just the other day, for example, I saw an offering for a property in Florida, and it was in that Space Coast area, which I happen to be familiar with. And it can be a rough area. It's a very block by block specific. So my antennas were already up. Sure enough, I look up the property, and there were like two shootings nearby, like within a mile. So for me, that's not really exciting. For some people, it's okay to keep the excitement, but that for me is an automatic no, because I if I don't feel comfortable being in that area, then property managers or other key team members probably wouldn't be there, let alone residents. So these are some of the first checks that I look at, and then I go straight into the numbers because for me, I have a few non-negotiables, and a lot of that is predicated based on my view of the current markets, my view of the future markets, and then my own risk tolerance. So one of my first non-negotiables is cap rate compression, exit cap rate compression. I do a ton of reading and I'm curious by nature. So I have a general understanding of where markets are, where class A, B, C properties are trading in primary versus secondary versus tertiary markets. So I can make a pretty educated guess if for whatever reason the public data is not available, or I don't have the CoStar underwriting report on what the entry cap rate is, meaning what the current market cap rate is. But when I see compression, my hairs go up, and it's like you can't. If that's how the sponsor thinks, and again, that may very well be a function of their personal outlook, and if they believe cap rates will compress, that's how they're going to underwrite. It's just neither here nor there. It's just different. Um, but that's just not something I would negotiate. Uh-huh.
Can you explain, explain it like we're 12 or something, what a cap rate is?
You can think of the cap rate if you are hearing the concept for the first time as the rate of return that you would receive on the property if you bought it all cash. In other words, if there was no loan involved. And typically how it's calculated is the operating profit, which is known as net operating income of the property, then divided by the value of the property. Typically that would be the purchase price. So depending on where properties are trading at, that's where the market would be. And so when I reference market cap rate, that's what I'm looking at. So a lot of the big brokerage houses, right, and or databases like CoStar, RealPage, Yardi, they have that type of information. So are a wonderful source where you can find that. Um, so that's one of the first things, right? And these things are typically in the offering memo, right? And if the sponsor care to include the information, not all of them do, but you if the deal seems interesting enough, you can always request the underwrite. And then rent and rent growth assumptions. So again, you can do a very quick search, doesn't take more than a few minutes to figure out what the or even do a quick look through some of the public sources to see where current rents are trending, what the growth rates have been. And so there was a deal that I saw not too long ago, and on the paper it actually looks very conservative, 0% rent growth in year one. I think year two was a bit shaky, had like maybe 10% in year two, and then slowly dialing down to 4 and 3.33. So you think, oh, 3% is very conservative. But for that particular market, over the last year, rents have been declining by 2.5%, right? And so my question is, well, what are you going to do differently to stay flat if rents are declining? And naturally, or if you're assuming 0% rent growth in year one when the market is actually declining, then you'd better have some pretty robust cushions with respect to concessions, bad debt. You're likely going to have to give away like free rent, no fees and whatnot, which effectively brings you to the same net revenue number or the collected rent known as effective gross income. So, and these things, again, they just jump out at me when I look at the numbers. So cap rates and rents, these are the two variables when you start analyzing the deal that have the most potent impact on the valuation. Why cap rates? Because they're effectively an inverse multiplier when it comes to the valuation. That's really hard to find. And unfortunately, we're seeing that in the current environment, even with operators who've done an excellent job, grown NOI, but because cap rates have expanded, right, from the lows of 3, maybe 4 to the tunes of 6 or 7, depending on what asset class and which market. And nobody could have projected that, right? So really, really hard to fight that multiplier effect. So while I don't know where cap rates would be a year from now, let alone 5 years from now, I personally choose not to gamble, and I prefer to assume they will at least expand a little bit. And if they don't, then that's fantastic news for me and for my investors. And then why rents? Well, because everything flows from the down from the top line, right? And if you get the base wrong, then the whole P&L is off. And not only that, if you get the not only if you get the base wrong, but if you get the growth rate wrong, then you're starting with a wrong number, and then you're compounding your error year over year over year. Again, very difficult to catch up. Once you're behind, very difficult to catch up. So that's one thing that I see. And then to the extent it's included in the offering memo, I do want to see that there is good alignment in terms of fee structure. So the other day I saw a deal, it caught my attention, right? It was a Houston deal. Offered, I think it was 67,000 a door, which I mean, seems really low relative to the market is, but it also raises the question, are you in the hood or like where is that deal that is priced so low? But anyway, I figured let me take a look. Return profile seemed reasonable. And I opened the deck and it was a 10% acquisition fee and 5% property management fee, right? And now, granted, the split thereafter was 90-10. So, but I have an issue with that, right? Because in that case, the sponsor gets compensated up front. They're taking pretty much zero risk, and all the risk is borne by the LPs. So, I absolutely want the sponsor to be well compensated. I absolutely want the sponsor to be well motivated. And in fact, I've also declined deals where I thought the margins were too thin, where they were giving away the deal for free. In that case, in the opposite case, right, there were pretty much almost no fees with 90-10 splits. And while all of that on paper seems very favorable for LPs, it leaves zero incentive for the sponsor to work on the deal, especially if challenges arise. And we both know challenges do arise. It's a business after all, so unexpected things happen.
That
So do you
sounds like that
have,
might be like the only way the deal would have worked is if they do that, they don't pay any acquisition fees up front or something.
Could
Um,
be, could be.
but
I honestly I put it away. I was like, that's enough for me. I didn't even look further. But if a deal looks interesting enough, I definitely want to dig into the underwrite. And I've shifted my stance on that. I was maybe a little bit more open to receiving that over PDF because some sponsors would decline to do that on the basis of, oh, I have a proprietary model. Um, I've shifted away from that. So unless they can provide the full unlocked Excel underwrite to me, it's a no-go. I need to see the full underwrite. I need to dig into their assumptions. I need to see how they underwrote the deal. Um, and go through everything with a fine-tooth comb because again, I'm placing not only my own capital, but that of other investors potentially. So if they're not transparent from the beginning, what confidence do I have that they'll be transparent once we are in the deal? And definitely want to go through their track record. A lot of people talk about track record, but it's also important to at least acknowledge, right, that so the 0809 crisis happened. Multifamily really didn't hit bottom until about 2010, 2011. And from 2010, 11 up to 2021, it was a ride up on the roller coaster, right? So up, up, up. So even if you operationally you were not very successful, you got bailed out by the cap rate compression. And so when I uh, receive or see the track record charts with 30% IRR, what I'm really looking for and what I ask them to share is how did their NOI perform relative to the original projections? And if they don't share that, which has happened before because I was told they were too busy, and I'm not disputing they're not busy people, but that for me is a pencils down moment. Again, I need to see the numbers, and there are plenty of deals out there. There are plenty of sponsors out there, so it's okay if I miss out on one that I feel is maybe not fully transparent. And how they communicate, like everyone has requires different level of detail. I'm a very detail oriented person. Maybe that's why I became a lender after some time. So that's in my DNA. But I like to see the reports. And at a minimum, I like to know that they are available, like the full financial statement, a balance sheet, income statement, statement of cash flow, of course, the rent roll, the general ledger, AR, AP aging. Not all of them will include it in their report package, but as long as it's available and I have access to it, that gives me comfort. Because what a lot of people also do is they invest in the deal and they kind of check out. But I would say both for active and passive investors, it's important to monitor your investment, right? For the sponsor, so they can proactively address issues when they see those issues emerge. And then for the LP, at least read the update or the executive summary provided to you by the sponsor. So if God forbid the deal is not going great, you're not waking up one day finding out, oh, I lost my money. So hopefully the sponsor is communicating that all throughout. Although I've had opposite cases where LPs close on the deal, never heard back from the sponsor until one beautiful day they got an email saying, "My congratulations, we lost the property." So these things too happen. And so how do you control for that? I mean, you really oftentimes they'll tell you what you want to hear. That's why it's good to take the time to talk to other investors, maybe other partners, ask for these sample communications, right? If the communication that you see doesn't meet your requirements, that gives you the answer right there, right? So there are no surprises post close, but take the time, don't rush. I know it's very tempting to like rush into a deal and you get bombarded with the messages of 80% full, 85% full, 91.5% full. Come on one, come on all. The sponsor is under pressure, right? Because they have a contract and their deadlines and they have to fulfill their contractual obligation. But I promise you, there is always going to be a next deal. The worst thing you can do is have remorse after you invest or not being able to sleep at night because you didn't vet or you didn't ask all the questions you thought you should ask. So sorry, I know I keep talking a lot, so let me pause for a moment because I can keep going on and on and on.
No, that's great. So transparency is a big one. And you also mentioned acquisition fee and
Mm-hmm,
splits.
mm-hmm,
I know this is a loaded question, but like, could you give us like what you see as reasonable? I know what I'm used to seeing, but I'm just
mm-hmm.
wondering from your perspective, what is not a red flag at all?
Yeah, I would say 2 to 3% of the purchase price. That's reasonable. More often than not, if it's a 2% acquisition fee, there is usually a 1% disposition fee on the back end. Um, where sometimes I have issues with that is uh, depending on how the capital waterfall is structured in situations where the deal may not be doing great. Because if the deal is failing, typically transaction fees, which the exit fee is part of, would fall into those transaction fees. So in reality, the sponsor gets paid first in those scenarios before the LPs do. So normally I wouldn't have an issue with that, but if a deal is failing, right, hopefully the sponsor steps up and says, "Hey guys, we're not going to collect this fee because we didn't perform, but instead here is to cover whatever shortfall we have, right, with your principal investment." Um, and I can definitely come back to the waterfall question. And then the other fee is asset management. That can be a tricky one, right? The typical asset management fee is about 2% of effective gross income. There was one deal where it was like 5%, but it was based on NOI, so based on the profit, which is even better because it really incentivizes the team to watch the bottom line. But what I run away from and just doesn't align with me at all is asset management fees based on the equity raised. And I see a lot more of these popping up because I understand syndicators are struggling, but that to me is an automatic no, red flag, misalignment of incentives. And just to be clear, I'm talking about single asset syndication deals, right? If you're in a fund, the asset management fees, which is typically 2%, is typically based on the capital committed to the fund. So that's not unusual when you're talking about the fund structure. What I'm referencing is a traditional single asset syndication deal where if it's based on equity raise, that's like, again, misalignment of incentives, so automatic no. And probably the third one I'll mention, that's a tricky one, is the construction management fee. I have no issue with when that is in the deal. But there need to be performance levers, right? If the operator blows through the budget or maybe doesn't deliver on time, they should not be collecting that fee because they didn't perform. But again, oftentimes the way the agreement is written is doesn't always provide clarity on how that is structured. So that would be a question to ask up front and then assess, right? Are there other buffers in the deal that make you more comfortable? And if not, then walk away if you feel the incentives are misaligned.
Yeah. So I'm noticing like the guest list here. I'm just looking at our guests and
Uh-huh.
seeing a mixture of people who actually underwrite themselves some friends
Mhm.
of ours, maybe, that we know, and so or that at least that you and I know individually, and then some people who are just purely limited partners, LPs, as you're calling them.
Mhm.
So um, there might be someone who didn't even know the term LP. You know what I
Okay.
mean? So
Okay.
I think we have all
Oh, okay.
the
Sorry, I'm
full,
going.
no, I just think we
Yeah.
have the full spectrum here.
Spectrum, yeah.
So I just wanted to like we've spoken to, I think, I think we've spoken to
Yep.
most of the spectrum, but just to take
Yep.
it to
Yep.
those people that are just getting started,
Mm-hmm.
um, maybe they've never invested, or maybe they've invested once or twice, but didn't
Mm-hmm.
really know what they're looking for. Just kind of they trust their
Mm-hmm.
sponsor. They trust the team. They got a
Mm-hmm.
good sense, and I think that's a huge part of it, obviously.
Absolutely. Mm-hmm.
Um, but what can they do? Like what if their sponsor offers them a deal and says, "Hey, we have an opportunity to invest. Take a look at our offering memo.
Mm-hmm.
This is why we
Mm-hmm.
love the market XYZ." What can they do? Do you have some kind of list of questions they ask or due
Mm-hmm.
diligence they do on their end?
And I'm really glad that you asked this question. So I'm assuming that at that point of time, they've already answered probably the three most important questions. Why am I even getting involved in real estate? I mean, that needs to be answered up front. And what are my investment goals and criteria? And what asset class do I want to pursue? And then the next step is really start diving into that asset class and go deep to learn about the markets, learn how to evaluate a deal in that asset class. So I'm assuming that, and then getting on as many lists as you can so you can start seeing deal flow, because at the end of the day, it's a numbers game and it's like muscle memory. The more deals you do and analyze, even if you don't get into a deal, the more comfortable you'll get with it. So based on what you shared, I'm going to assume they're in that stage where they're still learning the asset class and getting on various lists and now starting to receive opportunities. So definitely underwriting is where I would start, and not to intimidate anyone, but it's pretty much the ability to analyze a deal right from beginning to end. And um, that's a big reason why I wrote the book. And my goal was to write it in plain English, so it's not intimidating to anyone who's never done real estate before. And in the book, I actually provide, I mean, I've updated it since, but in the book, one of the book resources that I include among many is a very detailed 60 plus questionnaire that I myself utilize when vetting sponsors. And it goes into sponsors, markets, and deals, right? So I've included all three that they can tap into and leverage. But some of the things that we talked about is understanding who the sponsor is, what's their track record, what is the team. When you talk about track record, I can guarantee you that almost anyone who closed the deal between 2020 and 2022 has probably done at least one capital call, probably more, or equivalent, right? Bringing in pref equity partners or pause distribution. So in those instances, hopefully they're bringing that up front. And I'm not suggesting that you should look for perfection, because at the end of the day, it's like running a business. So nothing ever goes as planned, and sometimes you win some deals, sometimes well, you hopefully don't lose capital, but you maybe you don't perform as well. But it's important to understand with those situations, or if they hopefully didn't have a capital call or lost foreclosed deal or pause distributions, what did they learn from it? And how have they implemented that learning in their current processes, and have them demonstrate that to you. So really understanding that history, absolutely doing background checks. Hopefully in you won't ever find anything, but there was a case where there was a syndicator, right, who committed fraud, went to jail, got out of jail, changed his name, started syndicating again, defrauding people. So you're not going to catch that unless you do a deep background check. And in my case, I like to hire private investigators to go deeper because, again, of the fiduciary responsibility I carry. But if you do absolutely nothing, at least like Google the name and do there are like $50 checks that you can do. There are a lot of sites that offer that. So hopefully if there are situations like that, they pop up upfront, and not, you don't find out after the fact, right? That they did that, and frankly, they have to disclose that to you. It's part of the SEC requirements, right? If that was the case, they have to uh, disclose like the bad actor factor. But I mean, who knows? Like if they're unethical to begin with, they may really not care about that. So those things really help with the sponsor. And then with the deal, like I mentioned, there some of my non-negotiables, right? The really understanding the where the market is trending, and have them show you, right? Have them walk you through the comps, have them walk you through on the sales side, have them walk you through the comps on the rent side. You can ask about the cap rate and they can share with you, here's how I structured it, and this is why. Like I was actually on an investor call yesterday, right? And they shared, yeah, I was presented with a deal and I asked the sponsor what the exit cap rate is, and they didn't know. And it's like, well, they should know. I mean, that's like a big one. I understand if they didn't know the comp on 123 Main Street, right? I don't expect them to memorize that, but come on, like really, and you're presenting to investors, so they should be able to walk you through these things in great detail. And all it takes for you, right, as an investor is to ask the question, and let them talk, right? And they'll share with you how they think through the deal. One of my favorite questions to ask is why I shouldn't do the deal, and that naturally transitions to analyzing risk, and that usually stumbles people. They're like, "What do you mean? Like, I'm presenting you the deal. I want to do the deal." So, but I really want to know how they think about the risk, and not necessarily the 40 pages in the PPM that talk about the doomsday that will come and anything and everything that can go wrong with the property, which, by the way, I encourage investors to read, because that's another area where the sponsor talks about those risks. But that's mostly legalese. A lot of these are standard carve-outs. But have them walk you through what are the 3 to 5 key risks with this deal, and why do you think they're mitigated and acceptable.
Yeah,
So
so on that subject, what do you think are some of the important cushions that a deal should have to be mitigated for risk?
well, realistic assumptions, that's one for sure. So I covered the cap rate and rent/rent growth assumptions. Another big one that I see a lot of sponsors skimping on these days is reserves. I mean, I have my own number for what I want to see for reserves, but oftentimes, at best, maybe I see 3 months. In most of the deals I've seen, it's almost zero. And a lot of people say, well, we'll just carve out a piece of cash flow. But what if the cash flow doesn't come, right? What if the cash flow isn't there? What if you get raided by ICE and all of a sudden your occupancy drops to 70, which, by the way, is happening all over the country, especially in Texas these days. I mean, how do you forecast that? You can't. You can't forecast any of that, but that's why it's important to have a rainy day fund, right? With capex, okay, now we all know about the tariffs, and that's the number is kind of out there. But if you're in a deal, kind of in the middle of the deal, in the middle of the project, and the announcement comes right with the new administration, that's why you have buffers, right, in the capex budget, and hopefully those are not just, again, templates that you picked up from a spreadsheet. Hopefully, which I've seen also happen surprisingly, but hopefully these are vetted numbers, right, provided by contractors. And then last but not least, having realistic expectation of expenses. I know we always think, oh, we're going to be better than the last guy or gal, in running the property. And that may very well be the case, but there's certain things that won't change, right? Like the tax assessment protocol, how insurance operates. And I know this past year maybe it has come down from the peak, but always I wouldn't just apply the typical 3% growth rate that I see on a lot of deals. Actually, most deals do 3% rent, 2% expenses. And again, that may have been conservative when inflation was really low, almost zero, but not in the current environment. We all know labor costs have gone up, material costs have gone up. I mean, expenses have gone up substantially. So when I see a reduction, I'm not saying it's impossible, but it naturally raises the question, okay, help me connect the dots, and why do you think that's possible? And there may be a very good story, like, hey, we run 10 other properties across the street, right? So we can leverage the same staff, the same PM, and we're vertically integrated. And I mean, there could be a really good story behind why they think they can be more efficient. But at least it begs the question, to understand that. So these are some of the levers that I look at. And last but not least, definitely the debt structure. And I would have thought that people learned from what transpired in 2022, but not too long ago, right? I saw a deal where it was teetering around 90%, but I would call it stabilized. And ultimately the sponsor decided to take on a bridge loan. Granted, it was fixed rate debt, right? But it was bridge. So again, then you have to think about the refinance risk 3 years from now. And why are you getting bridge debt? Well, yeah, because it's highly levered. So that naturally, and it reduces the tenor of the deal, potentially, right? So all of that boosts your IRR and boosts your returns. Um, but it also increases the risk profile of the deal, right? So to me, it raises the question, okay, why are you in that example, right? Why would you not get permanent debt and not have to worry about your deal maturing in 3 years? Because guess what? If it matures in three, the lender is hounding you in year two, probably in month 18. Like, hey, what are you doing? Where are we headed, right? So and a lot of times people say, oh, we have an extension option and this and that, but option is the key word here. It's not a guarantee, right? The lender is in no way obligated to extend the loan. And if or when they do, it will come with additional requests, right? There's no free lunch, it's a two-way street. So you better be prepared to, or at least think through and understand what those requests might be upfront. Um, and then maybe one more item I would add that's not necessarily on the deal, but really I want to understand what the skin in the game is for the sponsors, right? How much money are they really putting in the deal? And sometimes the GP team will collectively put the money, right? It's 5 to 10% is the typical. And these days, most lenders require 10%. So not at all uncommon to see that number, but really want to understand like how much do they have vested into the deal? Are they signing on the loan? Which I had last week. Actually, I had a whole talk on LinkedIn about non-recourse loans and how they're not maybe truly non-recourse because you have to read the fine print there. But you really want to understand like because if they have zero money in the game, maybe they're not even signing on the loan. Like what? Again, they can just hand the keys and walk away unscathed, and then the LPs are left holding the bag. So and in the current environment also peers through how is the rest of the portfolio doing, right? Because there's a lot, it's not secret, right, that commercial real estate is going through its winter season, and multifamily being part of it is going through its winter season. So a lot of deals are in distress nowadays. There are a lot of capital calls. We're going to start seeing probably more foreclosures. It's just a natural part of the cycle. But you don't want to end up in a property that's really performing well and then find out that it's being cross-collateralized with a bunch of bad properties, which right now is happening because that's the only thing a lot of operators have left on the table. So hopefully they have deep pockets and deep balance sheets to step in, right? And in the earlier example, right, that I was sharing with reserves, if maybe you're okay with walking into a deal with thinner reserves, then you must acknowledge, right, the higher probability of pause distributions or capital call, or at a minimum, maybe the sponsor can give you some reassurance that they have deep enough pockets to where they can step in and provide adequate capital in those moments of cash flow and liquidity compression, to support the deal, right? And not call you for more money. So these are some, I guess, some of the cushions or levers I would be looking at.
Yeah, it's so smart because these are the things you don't think about when you're like all excited about the deal,
Yes.
and it does kind of look like sunshine and roses. And
Yes.
then you really find out how the team is when times get tough.
Mm-hmm.
Um, I see that it is well on the East Coast, it's 8:43. For you, it's 5:43,
Yes.
right?
Yes.
Um, but I do want to give people an opportunity to ask questions if they have any. So please unmute yourself. Vessi specifically said she wants this to be like a fireside chat type of thing, and interactive if people want to ask questions. So if you want to put a question in the chat or unmute yourself, please do take the opportunity to do that.
Got one, maybe a loaded one. Thank you, Vessi. Thank you,
Of
Hilary.
course.
Appreciate the time. Um, I've been underwriting for, I don't know, maybe a year and a half, and it's just
Mhm.
like you take the deal and you go down each line item, and it is just hard to get a deal and kind of getting burnt out. It
Mhm.
like, is it just normal to keep underwriting and not
Mhm.
see it? You almost
Mhm.
start doubting that it's just like, do I really need that? Can I squeeze a little bit here? Can I can I cheat a little bit here and make the price just $100,000
Don't
more
cheat.
to I'm just throwing
I
out
know.
language, but yeah.
No, but I know what you mean. The answer is don't. So the reality is it takes hundreds of deals, right, before you find the one. And in this market, probably more because at the peak of the market, right, the deal flow was abundant. Now, well, deal flow is now starting to come back. But I don't know if that will make you feel better, but I haven't done a deal in over a year at this point. And it's for very similar reasons that you shared. And um, what you don't want to do, and I mean, at some point, I guess if you've been in the business long enough, we've all experienced losses. I have experienced losses myself, right? And that's also part of the reason why I have a very firm sandbox, right? And why I try not to deviate from it. Um, but that type of loss can set you back years, right? Because if you think about it, that one loss wipes out 100% of your capital, and then it will take you twice as long, or twice you need to generate a return twice higher to just make up for the loss and break even. I'm not just talking making a profit. So you're definitely much better off on missing out on a great deal than getting into a really, really bad one. And I can tell you, again, learning from my own mistakes is where I had that maybe call it atrium effect of like the peer social media. Hey, I'm closing a deal once a quarter, right? And you're sitting here and what am I doing wrong? I can tell you that some of those deals that I saw, they're not doing great right now. So, but that's hindsight, 2020, 5 years later, right? And in cases where I did had that shiny object syndrome, or um, hey, I'm maybe being too conservative. These are the cases where I've made mistakes. So again, this is just my personal experience and my view, but it's better to be disciplined, right, and adhere to your criteria. I can tell you that even for a lot of the deals that are hitting the market now that are quote unquote distressed, a lot of them are not even worth the note and the loan principal. Like, so yeah, I mean, they're distressed. Yeah, they're deeply discounted from, but it doesn't make them a good buy. They're just, a lot of them are not even worth the note. So let alone the deals that you're receiving, right, from brokers, which they don't necessarily have that history behind them. So uh, we are going to go through repricing. I don't think we've seen the worst of it yet, right? All those loans, it was what, 800 billion, right, that are maturing this year and next year, a lot of which got kicked out from last year. A lot of them will have to start trading now. So we'll start seeing more foreclosures, more distress. They're already happening actually. So I've seen a couple just this first quarter, and then the other day, I think Arbor announced in their earnings call that they're going to start taking keys at this point. So the opportunities will come, right? But don't jump into one at any cost, because just because it has the marketing label of distressed, right, doesn't mean it's priced appropriately. And you make money when you buy. That's the reality. So if it's mispriced, you're already starting from a hole, like trying to dig your way out. Um, so yeah, don't get discouraged. And if you, I had a discussion, right, with someone at a conference not too long ago. We were again chatting cap rates. Get two investors in a room and mention the word cap rates, and then you're gonna have a ton of fun. But it was again like my philosophy is rates are gonna be higher for longer. There are a lot of other factors that drive cap rates, not just interest rates, but for that reason, that's how I underwrite. But their stance was, well, aren't you missing on great opportunities or deals that could be great opportunities? And the short answer is, yeah, I may be, but I'm okay with that, because I've also experienced the other side of the equation where I compromised and now I have to play catch up, right? So but if your risk tolerance is higher, right? Like, so for that particular investor, they're looking at cap rate compression at exit. And of course, then the deal pencils in beautifully, right? It fits right in the box of what LPs want to see. But again, it's important to be realistic. It's not what you want to hear or want to see, but it's what you need to hear and what you need to see. Hopefully that gives you some perspective. That's
Appreciate
helpful.
it. Appreciate it. Thank you.
Mhm.
That's the one thing that I think is surprising, but also maybe it's good news for limited partners when they hear that we really do analyze like hundreds in some cases of deals before we find one that actually works, because there's just so many factors that make it risky or not even something that we want to pursue at all with the heavy underwriting, and just it doesn't even pass the first first passes, it's out.
Mhm.
But yeah, I bet. Keep going, man. Keep going, and then tell us your story when you find one. Okay, here's a question from Eric.
Okay.
Great info. Are there any specific areas you're seeing to buy multifamily currently or emerging areas?
Great question. So yes, I do think there's still opportunities out there. Harder to find, but they're still out there, and they'll come really from two areas. One would be distressed owners, but not necessarily distressed deals. So they've run out of money, and the only way to find that out is if you stay active in the market, meaning continue to look at deals. Um, and probably less, I would say maybe less popular. I'm not going to say known because they're definitely known, but less popular markets, right? So like probably some of my best performing deals are in Statesboro, Georgia, right? So that market, maybe not many people have heard of it, but it has some really strong fundamentals. So tertiary markets like that one, I think now Augusta is coming up as well, and these both happen to be in Georgia. But tertiary markets that have strong fundamentals, and I emphasize that because tertiary markets can also be very risky, right? So, but I think that's where those opportunities will come from. Not suggesting that there won't be others. And if you're someone who's maybe not a cash flow investor like I am, and who has higher risk tolerance, then definitely staying close to loan brokers, mortgage brokers, and lenders, because they see these opportunities first. So there will be some good money made there if you can stomach, right? Getting a property that's 50% occupied with a bunch of deferred maintenance, 1960s, maybe 70s old. But there are operators who are literally gulping up portfolios right now of those. And why are they getting these deals is because they're the first call from the lender, right? The lender is looking to dispose of the deals, and they need a strong operator who can take over, and they're effectively renegotiating the note, right? Or if you're staying close to brokers, a lot of the activity that brokers were working on last year were broker opinions of value, basically providing informal valuation to lenders. So the broker is going to be the first one to know, okay, this deal is probably going to be trading. So if they have the confidence that you're someone who can take that deal down, then you're probably going to get that call, right? And a lot of these deals, by the way, that I'm referring to, I haven't seen them out there, right, in the public. All of these are happening behind the scenes.
Thank you.
Mhm.
Before we go, Vessi, I wonder if you could just give just some basic like about your book, which I have here.
Uh-huh. Uh-huh.
What was your motivation for writing this, and kind of the biggest takeaways?
Absolutely. So I would say a lot of it was inspired by everything that I had witnessed over the past couple of years, because I work with private investors and to help them evaluate deals. So I do second set of eyes analysis, either for capital allocators who are looking to place capital on a deal, or perhaps passive investors who are maybe not quite sure how to even analyze a deal. So they would reach out to someone like me to help them navigate through the process. And over that period of time, a lot of the calls I was getting were, "Hey, I'm not even sure how my deal is doing. Can you take a look at the numbers?" Or, "Hey, I got a capital call. What do I do now?" And then was like, "Hey, I got a second capital call. What do I do now?" I mean, I cannot say that I can completely isolate the emotions going through that experience along with the investor. And I've asked myself, well, how can I be part of the solution, right? I cannot clone myself, although now with AI, apparently you can clone yourself, but that was not the case when I was considering the book. And that's what really inspired me to write it in plain English, because I feel like a lot of the resources out there, they're well written, they're well structured resources, but unless you have a background in commercial real estate or finance, sometimes they may be over your head. So the goal is to write it in plain English and really help the everyday investor learn how to analyze a deal from beginning to end, so they can confidently make their own investment decision and not what they're being told by the sponsor, their best friend, or social media. So that was a big driver for it. And as far as the key takeaways is that anyone can learn underwriting. It's like you can think of it like dancing or like a foreign language, right? Or working out, right? You're not born knowing how to dance, but eventually you take a lesson or two, you step left, you step right, you get the rhythm, right? And you learn how to do it. Or working out, you build that muscle with a lot of reps over time, and then you maintain it, right? By, in this case, looking at a ton of deals, staying engaged in the market. Being active doesn't necessarily mean closing deals as an LP or a GP. Being active is being aware, following the deal flow, following the markets. And so I really wanted to emphasize the message that anyone can learn underwriting. You don't, or let's just say analyze deal, because sometimes even the word underwriting, I feel like, may intimidate people. It's accessible. And the one unique point that I added in the book, which again is specifically targeted for beginner investors, right? Is the lender angle, because I've been on the other side of the equation, if you will, or on the other side of the table. So I have another whole chapter dedicated on how lenders think and important points to keep in mind as an investor, which is also helpful for passive investors, right? Because these are, again, questions they can raise to the sponsor. And then throughout the book, I chime in with, here's how a lender would think about that situation. Because the lender is your biggest partner in the deal, right? Typically contributing 50 to 60% of the capital. So it's important to understand that perspective. So from the beginner angle and then the lender angle, really make it unique and help it fill a special place out there.
Yeah, so it really is for everybody. Well, I think it's awesome that you wrote this big fat thing. That's crazy.
Thank you.
But thank you so much for sharing your expertise in many ways. How can people find you if they want to get in touch with you, if they have maybe they even can just keep it in mind for when they they need to get in touch with you when a
Absolutely.
deal comes along or something like that.
Absolutely. So there are different ways. So for passive investing and passive investing resources, dbacapitalgroup.com, which is D as in dream, B as in belief, A as in achieve. For all things underwriting, masteringmultifamilyunderwriting.com, which also happens to be the name of the book. So very easy to find. And on social media, primarily hang out on LinkedIn, but you can also find me on Facebook. I'm finally on Instagram. I had to get dragged down there as well. So, but if you message me, probably LinkedIn or through one of these sites, my information is there, link to connect, and so I'm very very easy to reach. And always enjoy speaking with investors.
Amazing. Well, thank you again. And people, please reach out to Vessi. She's the best. We will send out this recording and thanks everybody for showing up and we'll see you on the next one.
Thanks,
Thanks,
Hilary.
Hilary.
Guys, thanks, Bessie.
Thank you.
Thank you.